Thank you everyone for joining us today for this webinar about digital assets. I'm Henrik Andersson and I'm the CIO of Apollo Capital. We're in a really interesting place now in the digital asset markets. So the timing of this webinar couldn't have been better. Bitcoin just went above 10,000 and there's an increased optimism in the space we haven't seen in a long time. The last few years, we've seen an increased interest for crypto as an alternative asset class among investors in Australia and also around the world. We have seen some of the largest VC firms and technology providers continue to invest in the space. Last year, we've seen Fidelity launch their digital asset custody, and we have seen Facebook launch Libra together with their partners. We have seen the first banks work directly with stablecoins. And just this week, we have seen Visa announce that they're going to increasingly support cryptocurrencies. And we also learned this week that US banks can custody digital assets. And for Apollo, we onboarded our first institutional investor earlier this year. And this trend is also supported by Coinbase, who recently released a report where they are seeing increased interest from institutional investors to allocate to digital assets. And that trend is also supported by custody solutions like Coinbase Custody, for example. As central banks around the world have adopted QE Unlimited, Bitcoin is increasingly being seen as a digital gold and one of the most scarce assets the world has ever seen. This narrative is gaining momentum as we speak. The latest reputable investor to invest into digital assets is Paul Tudor Jones. He announced recently in the last few months that the best profit maxing strategy is to own the fastest horse, and my bet is it will be Bitcoin. He highlighted the record monetary expansion we are seeing right now as a potential catalyst for Bitcoin. And my bet is that he won't be the last investor we hear about that invest into Bitcoin and digital assets. This increased interest have led to record volumes on institutional markets like CME and Bakkt, where institutional investors trade Bitcoin futures and also options. But digital assets is very far from just Bitcoin. DeFi, or Decentralized Finance, is seeing tremendous growth at the moment. And this is driven by a new type of crypto assets with a cash flow, and that's what's called yield farming as well. After years of iterations, we're now at the point where we have real cash flow on chain that is supporting these assets. And we also have a permissionless way to access new financial primitives. So this is, we believe, a true revolution in the making. Some of the examples of this growth that we're currently seeing are decentralized exchanges, or DEXs, where volumes now are measured in billions and equal to some of the largest exchanges in the world, like Coinbase, for example. Stablecoins, they have tripled in AUM just this year, and we now have over $10 billion in AUM in stablecoins. And the total value locked in DeFi has gone from 1 billion to 4 billion in a couple of months. We are moving to a world without barriers and with less middlemen. And we believe that that's ultimately a fairer and a better world. Today, we're very pleased to have 3 world-class panels. So on today's webinar, the first panel will be about digital asset as an alternative asset class. And we have some of the leading thinkers and investors in the space on this panel. Digital assets are slowly but surely finding its way to investors' portfolios. On the second panel today, we'll have some of the global leading infrastructure players in the crypto space. And these players are currently helping the adoption of digital assets when it comes to institutions. On the third and final panel, we'll talk about the DeFi, which is blowing up right now. We have 2 of the global leaders in DeFi for the last panel. I wouldn't want to miss that panel. During our panels, you can ask questions to the panelists. You can use the Q&A function in Zoom. So please ask all your questions, and then we will have a Q&A session at the end of each panel. But now I'll hand over to my colleague, Tim Johnston, who will moderate the first panel.
Thank you, Henrik. Great to be here, everyone, and thank you for joining us. My name is Tim Johnston. I'm the Managing Director of Apollo Capital, and I'll be moderating today's first panel, the topic of which is digital assets as an alternative asset class. We're very lucky to be joined by three wonderful panelists. I'm just going to start their videos and unmute them. Forgive me, I am getting used to Zoom. And Michael, as Henrik said, we really do encourage questions. The format today will be 20 minutes of discussion and 10 minutes at the end of each panel for questions from the audience. So we please do encourage questions. I'd love to hear what might be on your mind. So our three guests, let me introduce them. We have Deep Kapur, Michael Armitage, and Daniel Bar. I'll start by introducing Deep. Deep Kapur is a professor at Monash Business School, a member of the school executive committee, and concurrently director of the Monash Centre for Financial Studies. Deep has 3 decades experience in the investment industry, in institutional portfolio management, principal investing, research, advisory, and business administration. Deep, welcome.
Thank you.
We're also joined by Michael Armitage. Michael is principal of Fundlab and previously held the role as head of investment consulting for Mercer Australia. Michael has over 30 years of global markets, institutional strategy consulting, and alternative asset portfolio management experience. Welcome, Michael.
Good morning.
And we're also joined by Daniel Bar. Daniel is the founding director of, is it Bitforward? Daniel, is that right? Have I pronounced that correctly?
Yeah, Bitforward, yeah.
Excellent. Venture partner at Collider Ventures and an impact entrepreneurship fellow at the Edmund Hillary Fellowship. As an entrepreneur and investor in the decentralized web space, Daniel's work has contributed to the establishment of blockchain communities and venture ecosystem in APAC since 2015. Welcome, Daniel. Thanks for joining us.
Cheers.
So, gentlemen, thank you very much for joining us today. Fabulous to have your company. The topic, as I said, is digital assets as an alternative asset class. And I'm going to start with a broad question. We might start with your responses individually. We might start with Deep, Michael, and Daniel, and then we'll go to a group discussion and see where it takes us. But the first question is: what are the opportunities and challenges for family office and institutional investors in regards to digital assets? And as I said, Deep, if you might kick us off, please.
Sure. I think the biggest, the opportunity side, of course, at the end of the day, everyone wants to make money. And given the extreme volatility of some of the coins, it does open up opportunities for alpha generation, which perhaps is not available in some other parts of the market these days. But I think the biggest, it might be helpful to just work backwards from the challenges. I think the biggest challenge is most allocators do not understand this space. That is changing. I remember about 2 years ago, I had organized a roundtable of major super fund allocators in Melbourne for Tim to address, because we were all trying to educate ourselves. And at the end of that, after Henrik left, everyone said, wow, we learned so much, but we now feel that we actually know really nothing. So I think the biggest challenge in the space is really education. Everyone kind of gets it that, it's a new area, that we can't rely on the bond market to save us when equities go down by 50% in a bad recession. So we need something else to diversify, but people just do not understand what it is. People seem to feel that without a degree in computer science, they would not be able to understand the technology, and it's moving so fast. I think the family offices are a bit further along because they are agile. They don't have to write long memos to the investment committee to introduce a new asset class into the investment program. So I think it's less of an issue for family offices, when it comes to adoption and looking for opportunities. With the asset owners, large institutional investors, everyone, I think, has taken the view that a small allocation to crypto actively managed will likely improve the Sharpe ratio of the portfolio, which is basically where we're trying to get at. So everyone kind of gets it. But the biggest challenge for them is, as I see, in my conversations, is ESG, which is the environmental, social, and governance. And the issues differ as to whether it is coin or token. I think tokens are more likely to find faster adoption within the institutional, asset owner community. Tokens are, relatively free from some of the other issues that people perceive, and it also can be parked in the VC bucket.
Uh-huh.
So, that's a good fit. We are backing, a bunch of tokens, and that's really coming out of our VC bucket. Coins are harder. Energy intensity, and of course, look, I'm not an expert in the area. Things are changing. Different protocols are apparently in development, which would reduce the energy intensity of some of the coins. But overall, I agree with Henrik that there is a movement towards greater adoption. The pace might frustrate people like you running a business. But it might be the reverse of what Hemingway had written many years ago. How do you go bankrupt? Very slowly and then overnight. So it could be in reverse.
Excellent, thanks, Deep. Michael, keen to hear your thoughts on the opportunities and challenges for family office and institutional investors.
Look, I agree primarily with everything that Deep said. I think there is clearly two distinctions to be made, and Deep commented on it. Family offices, just by the nature of most of them, they're entrepreneurs, many of which are already in the technology industry. Their careers or their livelihood risk, educated risk, understanding risk, of course. But I think there's a natural, there always has been. They were always the first movers of any alternative asset class, hedge funds. The opportunity is, it's quite clear, right? We're at the very, very beginning of a new asset class or a new industry. So the asymmetric nature of the payoff is probably the thing that's most attractive to everybody. The challenges, as Deep commented, are the understanding, just getting your head around some of the terminology for somebody like me was quite difficult. So I think that that main challenge is that understanding the token economics or the valuation of these assets. There's an entire language to be learned, and I think that plays well for active managers in this space, especially if they can educate their investors or potential investors. And then there's a whole host of beneficial items to portfolios. A lot of people think the challenge is the volatility of the asset class. I agree. If you have an asymmetric asset, one that's not correlated to traditional assets, the volatility is not so much a concern. You can size that appropriately. And so from a standpoint of a world that we know is challenged in terms of negative real rates of return and expected challenges for growth going forward, this is one bright spot from an opportunistic standpoint. standpoint of massive potential growth, not just terrestrial kind of growth of 2 or 3%. We're talking very large. But challenge again is really understanding what is of value and what is just a good story. So that's my.
Excellent. Thank you, Michael. Daniel.
Cool. Yeah. I think I agree with both Deep and Michael, and the way that I kind of have my mental model to frame it is something Henrik touched on earlier with the QE infinity. So it's a bit of a meme calling it QE infinity, so quantitative easing to infinity, but it actually does represent a massive opportunity, because it's quite clear that we're moving to a world where basically old legacy traditional financial systems are going to not really keep up with the pace of innovation, not going to be keeping up with the pace of technology adoption. And by getting a piece of the action now, like by getting a piece of even just like the major coins, you're already getting your kind of foot in the door on this something that is like massive thing that is rising. So I think like as an opportunity hedge against QE infinity is a very obvious one. And then that also does tie into some of the challenges that both Michael and Deep touched on, which is, I think, given that it moves so fast, so basically we know like who are the people that are actually keeping abreast of all the things that are developing. It's really, really impossible to keep, right? And often I get that question of like, why should I get involved? Like, what kind of benefit would it bring me? Please convince me, right? So I usually like rephrase that question to ask, take a look at who are those people that are keeping abreast of it? What kind of demographic is it? What is the common denominator? And if you look at it, it's people all over the world that are typically on the very young side. So basically missing the opportunity of where all the millennial generation is going is totally a no-go, right? So that's in terms of both the opportunity and the challenge, because coming from institutional investment background, going to looking at crazy meme economy that is happening in the crypto market is it's a massive challenge. How do you write a deal memo for some meme coin? And those meme coins are basically like generating massive alpha, right? So understanding how to navigate that world is really, really challenging for well-established old money, so to speak. Yeah, that's more or less my take on it.
Excellent, thank you, Daniel. I think the other thing that I've come across and I guess is relevant to my background, I used to work at a large industry super fund, and sort of think about, well, how are they looking at the space and how would they look to invest? And I think another challenge will be the infrastructure and custody developments. So I think one of the reasons for structuring this webinar the way we have is that the next panel we'll hear from some of the key custody and infrastructure providers in the space, which I think will help break down those barriers to barriers for some of the larger institutional investors. So it'd be interesting to see what those panelists have to say. For the panelists here on this topic, another question which I think is an interesting one is, a lot of the people on today's call, institutional investors, family office investors, they're running broader portfolios, equities, bonds, private equity, bit of venture, a range of different asset classes. How do we think about crypto assets within a broader portfolio? And where do they fit? Do they fit in VC? Do they fit in foreign currency because of the currency similarities? Or do they have a completely independent bucket? Deep, I might throw to you first on this one.
I think at this point in time, I think it's sort of hard to put crypto into the currency bucket at this point in time, because no one really has, a major allocation in sort of, foreign currency is X. And plus, hypothetically, if you were to say Bitcoin is my preferred coin, It's also, I think, today hard to argue that it is a currency because it's, you can't pay your taxes in it. It's not a reserve currency. It's not in the SDR. So I think most investment committees would struggle to put it in a currency bucket. And also, currencies are supposed to have a certain volatility, but not as much as Bitcoin has or some of the other coins. So I think it probably won't fit in that bucket. I think that many institutions these days have a dedicated allocation to pure alpha generating activities. So it could fit in that bucket, uncorrelated stream of returns. And, as Michael said, it doesn't really matter what the volatility is, you just size it up. I mean, if it's got a 90% volatility, you allocate less money to it. So I think people are still trying to figure out where it would fit, but pretty much everybody has a sort of X private equity, X. So the alternatives bucket has private equity and infrastructure. They are big parts of it. And then you've got the sort of other. That's where it would fit. It would also fit, as I've alluded to before, within the VC component, especially if it's, looking at tokens as opposed to coins per se.
Excellent, thank you, Deep. Michael, how do you think about this topic?
Look, I think really with Bitcoin, some of the initial conversations are still ongoing, especially from an Australian point of view. The currency has of research at the level. Is Bitcoin specifically, is it really digital gold? And if it is, should it be in a head basket with Japanese yen, gold, and Bitcoin? And from that standpoint, if there is this kind of acknowledgement, the scarcity value of it, something that I'm concerned about, there's an opportunity there in terms of being more capital efficient. You do believe that it is digital gold, to hold less physical gold or hold less of some other currencies and maybe a small amount of Bitcoin. So, I mean, there's research there. There are people who are buyers and thinking along that line. I agree, for a broader institutional class, that's not, a day-to-day discussion. I think that if you look at the asset, the different assets, you probably can start to carve out things that are much more like VC. For example, in the DeFi space, I would look at a lot of those and probably consider them much more VC-like, albeit liquid, right? And I think a lot of it kind of just rubs me as it's fintech without necessarily having some kind of corporate ownership over the technology. So I think there's definitely a lot of similarity with VC, and very much the same way in terms of a curve or an asymmetric payoff. That I think a lot of people, and that's generally where we have seen the few institutions who have gotten some access have gone through the VC route, and that makes total sense because it's almost the same kind of, let's diversify to a bit of this asymmetric exposure. But that's generally how I would hang out right now. And as it matures, maybe that conversation can turn a bit more around stable coins fitting into some kind of currency.
That's an interesting thought, Michael, that within crypto assets broadly, you've got different parts of crypto assets that might belong to different parts of the portfolio. So parts of crypto assets belong to VC, parts belong to the gold or similar sort of allocation. So that's probably another layer of complexity for investors to think about.
I think another point to touch on it, that kind of trading, what we've seen, and Henrik pointed out, some of the biggest global macro names are certainly announcing that they're, dipping their toe or investing in space. It's very, very natural that a global in digital assets now, especially as in the DeFi spaces, that's starting to get volume and depth. Things like basis trading, volatility trading, are seeing funds start there as well. So there's a whole bunch of angles, different buckets of a return.
Sure, yeah. I'm just seeing a couple of questions come through, so thank you to those. Please keep them coming. It sounds like V is a common theme in terms of how we think about broader assets, crypto assets in the broader portfolio. Daniel, your thoughts on this one?
Yeah, actually, I think it's a great question, because like if 5 years ago you could say, cryptocurrencies, there was debate whether it's property or commodity or those kind of thing. I think that as we're moving to a cyber world and as this industry is developed, it's becoming clear that you're no longer having like one asset class here, even just in crypto. And like when we're looking at Bitcoin or ETH or stuff like that are more established and solid, weird to call it, but like let's call it that way, it's akin to like hard assets, even though it's software. It's akin to hard assets. And then so to Michael's comment on DeFi being more akin to VC, I think that it underpins, like there's an underlying narrative here that is becoming clearer and clearer over time. It's not just that DeFi is slightly similar to VC. So if with ICOs, we used to think that the VC model has been disintermediated, I think what's happening now after a little bit of maturation in the industry is that we're seeing in DeFi these governance tokens and basically the shift towards community governance and towards DAOs, DAOs, Decentralized Autonomous Organizations, right? And this basically is like taking an evolution of what does it mean to be a VC. It's no longer like a traditional VC. And this is basically like now becoming much more sophisticated in how things are tokenized and how things are, as you pointed out, more liquid. And this is basically like a trend that will definitely intensify. I think that DeFi is basically the tail of the elephant. The elephant is DAOs as a model, and we'll see it growing as we transition more and more into cyber world and as these crypto assets are becoming more widely adopted.
Yes, yeah. Another thought for me is it may also depend on how you invest in the crypto assets. If you invest in a fund like Apollo, it's probably more the hedge fund basket, or as Deep said, the pure alpha strategy. If you're just investing in Bitcoin, maybe that's the gold side of the portfolio. So perhaps the method of investing is relevant as well. We've got lots of questions coming through. Thank you for those submitted. Let's love to hear some more questions as well. Let's go to one of them. How does investing in digital assets in Australia? We've got quite an international panel here. How does it compare, in your experience, panelists, the Australian approach versus the international approach? Do we feel like Australian investors are on similar wavelengths to our international counterparts? I'm happy to throw to whoever wants to jump in first.
Yeah, I'm happy. I think so. Like I come originally from Israel, and I've been working a lot in China as well. I'd say that a few years ago when I came to Australia, the whole startup ecosystem was it felt very like innocent and new compared to some place like Israel. Like every person you meet in the street is an entrepreneur. But I think that like now with crypto, Australia is really becoming a massive hub. Like we see it with Sythentix and there's DHedge. It's becoming like a DeFi hub, and I think it makes a lot of sense, and it will start becoming like a cycle that amplifies itself. Like things were rather like slow and conservative in Australia compared to many other places in the world before. But I think that with the maturity of both the entrepreneurs and the investor community and generally like the more awareness globally to the talent, you see that it becomes like a very, very attractive and hot spot in the world. Yeah.
Did you have any thoughts on this? I guess I'm also interested from the investor or the institutional family office investor. Australian family offices thinking the same way as our international counterparts?
I'll jump in. At least from my experience here, it's just a matter of scale from the investment point, right? Certainly in the U.S., we've seen a lot of pension funds, announce their small, relatively small investments, still investments in the space. Superannuation, from my experience in Australia, very parochial. By and large, I don't want to say everybody, but there are a lot of different strategies that are applied in pension institutional portfolios in the state of Europe that we really don't see down here. And I'm talking about maybe derivative swap or, that. The same thing, this will be a slow uptake, Deep's point. There's a very kind of gatekeeper, board. Almost everybody's very homogenous in the way that they approach portfolio construction and investments here. Now, there are a handful, and it's like the constant handful of people that are always doing something new. And you probably see, who are the biggest investors in DC and Australia from the superannuation. They would most likely be the people that would be looking first. They tend to be the first mover in almost any new type of strategy. At the family office level, like I said earlier, and I think Dan just alluded to, you have a natural entrepreneurial streak, right? Australians like to take risk. I certainly see from the family office side, their interest in private markets seems to be stationary. It's just a matter of time starting to see those investors come through at that high net worth advisory level. We've had luncheons where we get a full room of those type of investors. I think it's just as we look forward, education, a bit of an upskilling here, but there is a natural, interest, and there's a natural risk taker in that family office crowd. And I think that's very similar.
Look, I relocated back to live in Australia after being away for 24 years and, spent a lot of time out. And certainly, I do find large differences between how people think about investments offshore and how it is done over here. And that may all change given the economic environment that we have, been in the last few months and how it's evolving. I think most Australians investing in the last 25, 30 years really haven't had to work that hard to make money. I mean, you could just be levered long real estate and amass vast amounts of wealth. You didn't need to be an entrepreneur. That's all you needed to do. And I think that whole game is now going to change. And I'm sorry to say this, but I do find the quality of investment dialogue that takes place in this country is intellectually, to me, not as stimulating as what I have offshore. And, to Dan's point, the ecosystem for startups was frankly terrible a few years ago when I came here. And, it seems to have improved. And I'm glad to know that Australia as a DeFi hub is making its mark. That's good to know. But everybody, I mean, there are 40 times more technology incubators in Australia than there are in Singapore. But, how many really large tech ventures have come out of these? So I just look at some of these data points and find that we have a long way to go. And this pandemic is a terrible thing from a public health point of view, jobs lost, etc. But hopefully there'll be a different focus on what actually makes an economy tick than just selling stuff to China and being long real estate.
And Deep, I'm curious to that point. Do you think that we need to go and play catch up to our international counterparts in terms of working harder to generate those investment returns and maybe thinking outside the box to generate those returns?
Yes, because just being long the stock and bond market is not to be very helpful on a 5-10 year view. That's my view. Other people have different points of view. The super funds are, the balanced funds are very long equity risk and so on. But perhaps they don't have a choice. I mean, I don't know. If you have $200 billion to invest, how much of alternatives can you really do? But it's going to be really hard. I mean, look at, everyone's all excited that the S&P 500 has recovered lost ground, but it's 5 stocks. It's S&P 5 that has taken the S&P 500 back to pre-COVID levels. The S&P X5 stocks are not doing that well. And, we haven't seen the worst of the earnings numbers and so on and so forth. So I just don't see how, without thinking outside the box, you can produce decent risk-adjusted returns going forward.
Yeah, I'll add one comment. I think there were quite a few discussions we had with Treasury. That was before recently, like the roadmap, Australia blockchain crypto roadmap initiative was started, and discussing with government how to actually start facilitating those thinking outside the box, not just at the individual teams or VCs level. Australia currently has, if I remember correctly, the super fund that is currently held in Australia is ranking after Japan or something like that. It's the top 5 in the world. And if super funds would only allocate 1% to VC activity and entrepreneurialism, that would have been a game changing in terms of the caliber of talent that Australia could attract. And this is something that is done. In Israel, for example, you have so many different government schemes to actually facilitate those investment vehicles into entrepreneurship that in Australia, it's still too slow. I was saying the good stuff because I'm more polite, but Deep, thanks for saying things as they are. But I think we are making progress overall. It's just that this is a slow moving beast.
Yeah, it's interesting points, Daniel. I think we're coming to the end of the session there. Thank you for those that submitted questions. Unfortunately, we couldn't get to them all. I think we're coming to the end now, so we'll prepare for the next topic on infrastructure in the digital asset space. But thank you, Daniel. Thank you, Deep. Thank you, Michael, for joining us. Some very interesting thoughts there. If anyone listening today has any specific questions for any of the panelists or would like to get in touch, their LinkedIn profiles are on our website, but also feel free to let me know and I'll be happy to connect you. But thank you again, gentlemen. Thanks for your time, and hopefully you enjoy the rest of the webinar.
Thank you.
Thanks for having us.
Okay. Attendees, bear with me 1 minute. I'm just going to introduce our next panelists and start their videos and their microphones and make sure everything's working. We'll just get that started now. Excellent.
Testing 1, 2, 3.
Excellent. Hey, Kayvon, how are you?
How are you?
Very good, thank you. We are also expecting Simon Kant today, who is our moderator. However, he hasn't arrived just yet, so I'll double up my moderation skills until Simon arrives. So let's kick off. We have our panelists, and the topic for this panel, which will again run for half an hour, 20 minutes of discussion, 10 minutes of questions from the audience. Topic is digital asset infrastructure, the developments and challenges. I think all our panels are going to be fantastic, but this one I think in particular is going to be really interesting because I know a lot of the investors I've spoken to have always asked questions about what's happening in the infrastructure space, custody problems, etc., etc. So I am joined today by Kayvon Pirestani. Kayvon is head of APAC institutional coverage for Coinbase. Prior to joining Coinbase, Kayvon had a career in equity derivatives at Morgan Stanley in Tokyo and Deutsche Bank in Hong Kong. Welcome, Kayvon.
Thank you very much.
We also have Jennifer Ilkiw. Jennifer is the head of Intercontinental Exchange, which for those that don't know is also the owner of the New York Stock Exchange and backed in Asia Pacific. Jennifer has been working with ICE for 13 years and was previously a director of the New York Mercantile Exchange Asia Pacific and assistant director of the Monetary Authority of Singapore. Welcome, Jennifer.
Thanks, Tim.
We, last but not least, have Grant Colthup, who is the CEO of Mind Digital, an Australian-based exchange. Grant is an experienced finance professional. He's held positions with the global macro hedge fund, Macquarie Bank, a prop trading firm, and was a portfolio manager at Insurance Australia Group, Australia's largest general insurance company. Welcome, Grant.
Thank you very much.
Excellent. So attendees, again, questions, please get them coming through. We would love to hear from you and love to pose some tough or not so tough questions to our panelists. But today, guys, I guess one of the main questions that we thought of when putting this panel together is what are you seeing is the biggest demand from institutional investors, and what are the common themes or the most common themes that you're seeing with the institutional investors that you talk to? Kayvon, you're first on my screen, so do you want to kick off?
Yeah, absolutely. Thanks for having us, Tim. Excited to be here today. So just as a reminder, sort of the role that Coinbase plays in this ecosystem, for those of you that aren't intimately familiar with Coinbase, we view ourselves as the leading on-ramp from the world of crypto and traditional finance into the world from the world of traditional finance into the world of crypto. And so a lot of investors, whether they be retail investors or institutional investors, view Coinbase as that gateway to get involved into crypto for the first time. So to answer your question with regard to institutional investors specifically, what are they doing? How are they doing it? Why are they doing it? I'll touch on a few things, but then I want to leave plenty of time for my fellow panelists to dig into it. So this question of the institutionalization of crypto has been around since 2017 and even before that, but it really picked up steam in 2017. And I think the question has often been very muddled. I think a lot of people view any sort of large company or large investor going into crypto as being a so-called institutional investor. That includes the likes of market makers such as Jump Trading in Chicago and others. But I think we're now at the stage where we can be a bit more nuanced about these conversations. So the state of play for institutional investment in crypto today is very much that market makers and proprietary trading firms like Jump are actively involved on Coinbase and many other platforms out there. But the reality is that many other types of institutional investors, the asset manager, the hedge fund, et cetera, are frankly today largely not involved. They're still on the sidelines. The good news, though, is that we're just starting to see the very first signs of that changing in a meaningful way. And one of the catalysts, which I believe has really started to usher in that change, has been some of the high-profile, sort of visible entries into crypto by the likes of Paul Tudor Jones earlier this year. And not only the fact that he entered that market, but he did so in a very visible way, and in a way that he put forth an argument that many others found compelling, convincing, and it really provided a lot of reputational top cover for other investors who've also been looking at crypto for a long time, but found that from a career risk perspective, it simply didn't make sense for them to do so. So since the Paul Tudor Jones news, we at Coinbase have been directly involved in a number of conversations with mainly what we would call the traditional hedge fund segment, mostly based in the US, who are now for the very first time allocating funds directly into spot crypto, so direct physical ownership of Bitcoin, for example, which is brand new, super interesting, and something we simply hadn't seen very much of before. We're also seeing some interest from the family office crowd, both in the US and elsewhere, doing the same thing. And their interest appears to be durable. So it wasn't a one-off spurt of, a single tranche, but we're seeing week after week, multiple hedge funds, including some of the biggest global macro investors, household names, making allocation week after week into primarily Bitcoin. So let me just pause right there and see what the other panelists have to add to that.
Yeah, thanks, Kayvon. That's very interesting. Jennifer, I might throw to you. Keen to hear what your thoughts are from an ICE perspective.
Yep, thanks, Tim. I agree with Kayvon. One of the pieces that when he was saying is that the institutional investor, you sort of have to separate them out. And one of the ways we also look at it is those who need to be in a regulated space. So what we're seeing a lot more of, and I think it's the same as where Kayvon is saying, when you're getting hedge funds, we're getting more asset managers coming in, they have to be in a regulated space where they need to participate on an exchange, potentially have a clearinghouse involved where it's regulated, and they can go to their shareholders and say, hey, we're doing this, but you don't have to worry because we're regulated. The exchange or the venue is regulated in the US or in Singapore or in Hong Kong or elsewhere. And the sort of back and forth in the last 2 or 3 years on regulation, and some firms being very pro it, some being a little bit more cautious about how that's going to change things, and how you've seen different changes in regulations, certainly in Asia through Japan, how Singapore is dealing with it, how Hong Kong is dealing with it, has made institutional investors a lot more comfortable, I think, coming into it. Because I think conversations we had 2 years ago, a firm would say, listen, we're interested, but it has to be regulated. And even if we're looking at the likes of CME or looking at the likes of ICE at that time to trade these contracts on, that they still didn't feel there was enough liquidity or participation in the market. So I think that's where Kayvon's saying, you see Paul Tudor Jones and other big players actually say, we are getting in, we're looking at this. This is something that's important to us to be able to study. And we've been able to use that when we go out to clients and say, listen, if you have your portfolio just by adding 1 or 2% into Bitcoin, this can change how your portfolio looks and how it looked in the past and how it could look going forward as well. So that's probably really the add-on that I'd want to say around that.
Great. Thank you, Jennifer. Grant, keen to hear from you.
All right, thank you. Yeah, I think as the two other panelists have done a really good job, I think, of outlining really where the state of play is. From my opinion, the way I think, from a most recently coming out of an asset manager, the regulated side for them is always going to probably be the hardest lift, and that's purely because we're talking about having to pass multiple layers of compliance and layers of regulation, and then ultimately it always falls back to this the concept of fiduciary responsibility and fiduciary duty, which, depending on what jurisdiction you are in the world, it can be a very nebulous and difficult concept to meet. So from a lot of boards and trustees and things like that, oftentimes, at the moment, if they still want to, they're more than capable of hiding, or not hiding, but, falling back on fiduciary responsibility as being able to, basically put a kibosh on any type of participation in crypto at the moment. But at the same time, I think, as we've just spoken about, those who are on, who are more comfortable with the risk, who understand the risk, I think on the infrastructure side, the part where it's making people a lot more comfortable is the amount of, the quality of the custodian offerings, i.e. Coinbase, OSL, etc., are very high these days. Those custodians are able to be covered by insurance markets quite easily. The cost of that insurance is coming down as well. So from that point of view, you're seeing the traditional infrastructure in markets that investment managers, asset managers are used to is coming all into place. I think they still struggle with this concept of, I guess, I think we spoke about this a couple of weeks ago, the fragmentation of the market still scares them again a little bit, and is something that they, that people haven't had to, take into account for a very long time. Obviously, we saw a little bit of that with, equity markets and dark pools in the, late 2000 into 2010s. But for mostly, it's been, you trade on a single source of truth, i.e. the ASX or something like that. And that's sort of the where they've got themselves to from a mindset. I think on the investment opportunity space, to me, this is something I think, Michael is, Armitage is obviously doing a great job with, and I know obviously, Tim, yourself and Henrik are trying to do is, I think the investment thesis is actually just criminally misunderstood by people looking into this space. I think we're doing I think everyone on this panel and the other panels and today are trying to do a great job of easing people into by saying, how about you put 1% in Bitcoin into your portfolios? But, that's just quite honestly underselling the space significantly, which again, I know we've got to get people to walk before they can run, but the depth and capacity and, just sheer uniqueness in this space, I think will blow people away.
Yeah, I think one of the pieces that we're still seeing is education. Even now is just getting people to even understand how Bitcoin works, to understand the mechanisms behind it, to understand potential risks behind it and how to value that is also still something that we're continuing to have to do. And as Kayvon said, it really seems to be much more of a focus on Bitcoin. When I talk to the institutional investors, they don't tend to talk about other coins. It really is just a focus on Bitcoin. And it could be just because that's the most of what's traded out there. That's where the volume is. That's one thing where they can start looking at and start to feel comfortable and start to look at how to manage that risk.
Yeah, that's really interesting, Jennifer, and I think that's a common theme in the first panel. We touched on one of the key challenges and opportunities for digital assets for family offices and institutional investors, and as I think Deep touched on in particular, that education, and it's going to take time, and it's a complex topic. I mean, for myself, I started in crypto in 2017, and I was very skeptical, and it takes a long time. And the only reason I'm here is because I was working in that job, and it was persisting with that I sort of learnt more about it. So yeah, education's key, but I think for everyone, as well as investors, it does take time to understand. And I think the other point there is we don't need to understand hash rates and Coinbases, to use the technical term of Coinbase, in the technology. It's a little bit like, if you're bullish on Tesla, you don't need to understand why Tesla's electric cars are superior to others out there on the market. It's just understanding that it is superior, if that's the case, and how that compares out in market forces.
No, I think, Tim, that's quite interesting, because my personal view has always been that this will be a market that really starts to take off when my mother doesn't even need to understand it. She's just comfortable using it without asking questions. So it's kind of like using a credit card. We don't ask about what happens when you use a credit card. Whereas my mother, like even when I'd gone home for Christmas last year and I was talking a little bit about crypto and Bitcoin, my parents had no clue with what I was talking about. So I think once everybody starts to really understand it, or just not even just feel comfortable enough not to ask about exactly the underlying underworks of it and be comfortable with it, we'll start to see a lot more adoption.
I think that's a great next question, Kayvon. Like, how much do you need to understand this, and also what's the level of sophistication of the conversations you're having with your clients and prospective clients? Is it they're all coming in at the same sort of point? But then once they've been a client for 12 months, the level of sophistication of that conversation is dramatically different. I'm very keen to hear your thoughts on that one.
Yeah, I totally want to double click on the idea of making all of this easier to use and easier to understand. I think to this day, my mom still thinks I work at Bitcoin, not Coinbase. This is always entertaining. But yeah, so it's interesting, Tim, the types of conversations we had back in 2017, 2018 were generally with what I would call crypto first investors who understood the underlying technology really well. In many cases, they were actually developers or engineers themselves, but were very unsophisticated in terms of thinking about global macro markets, inflation, or the sort of the bigger picture investment thesis behind Bitcoin. We're now faced with the opposite challenge, where we're interfacing with this new wave of traditional institutional involvement, folks like global macro investors who are very sophisticated in their thinking about investments, about the global macro environment, but then don't have the foggiest notion of what it means to custody a physical Bitcoin. And that's really where Coinbase excels. We're not experts on the global macro markets ourselves, but we're pretty good at explaining about the best way of handling, storing, trading this stuff, and the right way to start to think about sort of looking at the longer tail of assets. So now that you're comfortable with Bitcoin, does it make sense to look at something like Ethereum, and so on and so forth? So that's really the role that Coinbase plays in this ecosystem, and I think that's where we excel.
Grant, did you have any other thoughts on that topic?
Yeah, I think again the two other panelists have really hit that on the head. And I think I guess just come back to the point is, does everyone know everything about every investment they make from the most fundamental point of view? No. The greatest, in my opinion, the greatest price discovery mechanism in the world is pit trading. Most of the guys on the pit hat it wouldn't matter what they were trading, but they could find the price of that thing immediately and very effectively. And that's the beauty of markets. It's the combined wisdom into it is the price discovery mechanism. Personally, I do not have a highly technical background, but from my point of view, do I know that if I put a Bitcoin in a certain location, and is it likely to be safe? Yes. Does that satisfy me? Yes. But I think the other parts of it, it does just take some time to get people to interested in it. And as I said, I think the narrative, once we can get there of being able to show people the full, complement of opportunities that are available, i.e., the emergence. If we held this at say in December last year, we would have mentioned DeFi, and everyone would have said, "Oh yeah, it's a cool idea. You can put your Ethereum in something called a node. You might get 3% a year." And anyone in traditional finance is like, well, it's a little bit better than a T-note, but it's still barely compelling. Yet, we fast forward only 7 months, and you can, if you got in the right time, you could have staked M-Stable at 100%, and it's obviously has some risk to the technology, to the underlying, parts of the platform. But, from my point of view, being involved in credit and markets like that, it's asset backed, and it's basically dollar good, and you're almost extracting 100% annualized return from it. So I think this is just all new as well. I mean, as guys know, this has literally been a development in 3 months. So I think by the time we roll into 2021, or 12 months later, I think the DeFi narrative is going to just drive the real interest from traditional investors. I mean, there's a great thing I saw on LinkedIn about 8 weeks ago from a guy who, sort of like myself, came from a professional fixed interest background, and I agreed with it. And I said, if you're a fixed interest professional, you have no future. Yields will stay at zero forever. Credit volatility will go out of them. And if you're getting into DeFi now is getting into asset-backed securities was like in the 1980s. That's the best way I can put it.
Yeah, interesting thoughts, Grant. It's certainly jumping into the weeds there with some of those protocols, and that will be interesting to run this webinar in say another year with particularly with Kayvon and Jennifer, and to see if some of these institutional clients are demanding more sophisticated custody solutions for DeFi type products. We do have a great question from our audience. Audience, please feel free to use the Q&A function to ask our panelists some questions. This question is from Graham Bibby. Great question, and really sort of I'm interested to hear this at the high level. What is the current state of custody and security for digital assets? So maybe if we just one by one start with you, Jennifer, just a summary of the current state of custody and security for digital assets.
Well, I probably can't go as much about the broader. I can probably talk a little bit more about our side of it. We've seen a lot of continued demand for custody. Our solution tends to be looking at custody for larger clients that want to hold custody for a longer period of time and hold crypto for a longer period of time in a safe place. The thing that we always still focus traditionally on is the cybersecurity and the risk involved with that, and making sure that clients are comfortable about putting the crypto in there and they don't have to worry about any risk coming out. So there still continues to be a lot of managing the security side of it. And we see with sort of the recent article that in the US, banks can now custody crypto, that we're going to expect to see more of a demand out that. We see that as a very positive sign, that with banks being able to do that, that is really a step forward for the regulators to start accepting digital assets much more mainstream than they did before.
Yeah, that's a great point, Jennifer. That's yeah, I think that I saw another article follow up on that, which we shared in our newsletter yesterday, which is it doesn't necessarily is going to be in a rush from the banks, but the fact that it's permissible.
Yeah. I think just the fact that it's permissible, that it gives them a chance to look at it, because there's always sort of been questions back and forth about exactly why are banks getting in or why are banks not getting in. But as soon as you have sort of a regulator starting to say that these are things that can happen, that you will start to get more movement going forward on that, because you always have compliance and risk that will always offset, you know, when I'm a salesperson, so we want to do more and more, and you get the compliance risk, you know, trying to temper you back a little bit. Or from our point of view, I think they want to keep everyone safe.
Yeah, they have an important role to play.
Yeah, they do.
From a Coinbase perspective, what's the current state of custody and security for digital assets?
Yeah, so like Jennifer, I'll answer this question more from the perspective of Coinbase as opposed to market-wide, but acknowledging that Coinbase is today the current leader in crypto custody. We're by far the biggest crypto custodian in the world, with more than, this keeps ticking higher, but now more than $11 billion of crypto assets under custody. Those are all institutional assets, in addition to the 15 or so billion we have on the rest of our platform. But anyway, so I think it's worth asking sort of like what custody is, just to recap for everyone on the call. Custody is basically two main things. One is safekeeping, keeping my stuff safe. The other is servicing, so, you know, deriving the maximum value from the assets that you're holding. Now, back, 2-3 years ago when I joined Coinbase, clients were more focused on safekeeping and really didn't give a darn about the rest of it. They just wanted to make sure their stuff wasn't going to disappear. But interestingly, as this space has evolved and as the investors have matured a little bit, that they're less focused on the safekeeping question. I think some of this is thanks to Coinbase's brand, where they sort of implicitly trust that we're going to do what we say and make sure their Bitcoin doesn't get lost or stolen, and start to focus a bit more on the question of like, right, so I'm holding a bunch of Bitcoin with you. How can I make sure that you're delivering the maximum value for me? And that can involve things like lending. It can involve things like staking for proof of stake assets, and so on. And that's really where Coinbase is focused on today. It's deriving the maximum value. So we've started providing staking yield for a number of the proof of stake assets we hold, and we're adding to that list every day. And we're hard at work on giving our customers the ability to selectively lend out the Bitcoin or other assets they hold in a way that's highly risk controlled and in a way that they can derive additional yield on their investments even as they remain immobilized in cold storage custody. So that's the state of play from Coinbase's perspective.
And Kayvon, one question I'm interested to know is, what percentage of your institutional family office clients would hold just Bitcoin versus those that would hold Bitcoin and a raft of other crypto assets?
Yeah, so the easiest way to answer that question is that I would say the traditional segments in aggregate, be it family office plus traditional hedge funds, probably have 90+% of their portfolios allocated to Bitcoin. Many of them, the vast majority of them, are only Bitcoin, but I don't know exactly how that breaks down. But it's pretty much a Bitcoin only story at this point. And I think there's two reasons for that. Number one, as Jennifer alluded to earlier, is that the infrastructure for Bitcoin is simply much more developed. It's much more of a regulatory recognition around it, et cetera. But number two, and I think this is important to remember right now, is that the thesis for Bitcoin in light of COVID, quantitative easing around N, et cetera, has suddenly just become a lot more compelling than it was already. And so, you know, the intersection of those two things really makes the case for Bitcoin.
Yeah, and from an Apollo Capital point of view, we're very bullish on Bitcoin, but I think the next panel will be a good segue this will be a good segue to the next panel where we're going to talk about DeFi, and we're obviously, you know, with our portfolio, we see you know, a huge amount of value in the space that's not just Bitcoin, but you know, other crypto assets. Noting that for some institutional clients, that still might be a barrier because there might not be the appropriate custody and infrastructure developments within that segment of crypto assets. One final question for you all. We've got about 5 minutes, so we might be sharp on the reply, but how have you seen, speaking to, we're obviously based in Australia, most people on the call will be Australian. How have you seen the response from Australian institutional family office investors compared to the rest of the world? Jennifer, I might throw to you again.
Actually, we've seen more than I had expected, to be honest. We tend to do some business generally. So ICE covers obviously more than Bitcoin. We have a big softs portfolio, oil, and financial markets. But there's been more demand out of Australia, request developments that I've seen there. So one of the things is that I've talked to a firm about people have been talking about launching ETFs in Australia, which we hadn't seen anywhere else. Certainly out of the US, I don't think that's expected to happen for a good time. So I think there seems to be a lot more demand, interest. We see more trading out of there than we had expected as well.
Okay, great. Grant, might throw to you, and then we'll wrap up with Kayvon. Oh, sorry, Grant. Let me unmute you.
That's all right. Yeah, there's one. I'd probably speak to one or two main contacts in the family office space, and one especially he covers off on he covers off on multifamily groups. So probably in totality, he'd be covering like 20 smaller offices. Again, it's been probably pretty uneven from the feedback I see and get from them. Is that, you know, some are quite interested but still not doing anything. To others, you know, still very, you know, brick and mortar orientated, being Australian, and that's where they still want to be and are still on their, you know, focused. I think the big thing in Australia we have, you know, on, I guess not on the investing side, but you know, we do definitely have a outsized proportionate you know, activity and interest in the trading side of crypto derivatives, especially Bitcoin derivatives. We probably have, you know, 2 or 3 of the largest independent trading firms in crypto in totality are Australian based, and then we have, you know, several firms that are very large in the option space as well. So I really see Australia as being a massive hub going forward for the development of, especially for an Asian based crypto derivatives, and especially given the developments in Hong Kong. I think Australia becomes a very natural hub for that activity to occur.
Yeah. And Kayvon, keen to hear you to wrap up, and a selfless plug here, noting that Apollo Capital was the first institutional client of yours in Australia.
That's absolutely right, and I'm very pleased to have you guys on board. So the number of data points in Australia in the so-called institutional space, that is like family offices or traditional hedge funds, it isn't large, but what I will say is that they appear to be a little bit more adventurous than the ones in the US, in the sense that they're involved in some of this, like the bleeding edge new proof of stake assets, such as Algorand, such as Solana, which is not something I see that the big hedge funds in the US doing yet. So that's exciting to see.
Excellent. I think that wraps up the time for this panel. Thank you all very much. Some wonderful insights there. Hopefully our attendees took away a lot from that panel. I know I did. If attendees, if you do have any questions for Kayvon, Grant, or Jennifer, or follow up, again, their LinkedIn profiles are on the website that you registered at. But if you'd like to discuss further, please let me know, and I can facilitate introductions where relevant. Thanks again for your time, guys.
Thank you very much.
Thanks, guys.
I'm now going to throw back to Henrik, who will be moderating the last panel on DeFi. So just give me 1 second while I introduce our panelists. Okay, I think we've got Kain and Nick, and Henrik, you're there as well.
Fantastic. Yeah, I thought that was two really interesting panels. So really well done, everyone. And our last panel for today is about DeFi, which is probably the hottest topic in crypto right now, decentralized finance. And the title I wrote for this panel was From 0 to 1 billion, but it's actually 4 billion now, right? So there's 2 billion growth in a couple of months since we started organizing this panel. So today we are very pleased to have Kain Warwick and Nick Addison with us for this panel. And Kain is the founder of Sythentix, which is a derivatives liquidity platform built on Ethereum, which is currently one of the largest projects in the world in DeFi. And Kain is by many seen as the father of DeFi, or one of the fathers of DeFi. And Nick Addison is a solutions architect at ConsenSys. ConsenSys is the software engineering leader of the blockchain space and is behind products that we use every day in crypto, such as MetaMask, which has been downloaded more than 4 million times. And Nick is an IT professional specializing in blockchain and distributed ledger technologies and financial services. So very pleased to have both of you here today. And please remember to ask questions as well in the Q&A functions for Kain and Nick. So my first question today is just on a very high level. Why are we so excited about DeFi now, and what is happening in the space right now? And just remember that probably not everyone on this call is familiar with DeFi and what's happening in the space. So maybe I go to you first, Kain.
Sure. Yeah. Thanks, Henrik, and thanks for having me. So DeFi is a very broad category of platforms. Obviously, you've got things like lending platforms. You have trading platforms. You've got most of the sort of traditional financial infrastructure is being replicated in these decentralized finance systems and protocols. And I think the reason why there's so much excitement at the moment is we're just now starting to see what this permissionless financial infrastructure can do, right? You mentioned this $4 billion locked in DeFi at the moment. That's across, I think, 30 or 40 different protocols. And so, whereas in the traditional financial world, every single platform, each bank, et cetera, has their own sort of closed set of APIs, closed systems that may or may not be interoperable, and coordinating infrastructure to allow these different siloed systems to talk to one another takes a long time. It's very painful. You need consortiums and years of work to kind of get these systems to talk to each other. In DeFi, once the system is deployed to Ethereum, it's automatically interoperable. Anyone can kind of turn up and start to interact with it. They can build layers on top of it. They can integrate it into their own systems. And things like, for example, D-Hedge, which just launched a testnet recently. A bit of a shameless plug there, Henrik. But that platform exists without any coordination from Sythentix, right? So it's a layer that's built on top of Sythentix. It uses the Sythentix protocol, but it doesn't pay to access that. It didn't require permission. It didn't need API keys. It didn't need any kind of sign off from anyone on the Sythentix protocol team to allow that to happen. It was able to just turn up and consume the protocol. And the same goes for things like Compound, lending platforms, et cetera. So it's a really interesting position that we find ourselves in, where we've got this sort of Cambrian explosion of different platforms that are all speaking to each other and interoperable. And I think that's why there's so much excitement at the moment.
Cool. Yeah, Nick, do you agree that this composability in DeFi that is leading to the explosive growth right now we are seeing? Is that one of the?
It's definitely one of them, and probably the main one. It's what makes it exciting. But I'd also add, I see this as like a regulatory arbitrage. Like the promise of blockchain is to try and take the middle person out. So, while traditional financial institutions spend, hundreds of millions of dollars on compliance, which is a good thing. The DeFi space is definitely the Wild West. So, you can get higher returns, or, you can get, you can get the benefits of that because you don't have a lot of the overhead. But, the risks are higher, but the returns are higher as well. So I think that's another reason why there's an attraction to the space.
Yeah, I think that's very true. And Kain, you were tweeting about that yesterday. You had an epic tweet storm, I think, and you talked about the regulatory issues and what's going on in DeFi. Anything you want to add to what Nick just said?
Yeah, so I think Nick is right in that regard. There is an element of regulatory arbitrage here, and I don't think there is, depending on who you talk to, sort of a pejorative sense of like regulatory arbitrage sometimes. But I think in this case, for most of the DeFi platforms, it is really trying to build something that doesn't require the same level of regulatory oversight, right? One of the big reasons why you have regulatory oversight is you have people inside these organizations that have privileged positions that can do arbitrary things within a system. And if you don't have oversight to ensure that they're not doing the wrong thing, then, unfortunately, oftentimes they tend to do the wrong thing, right? Certainly enough that you have to add these layers of protections to ensure that you're inspecting what people are doing, et cetera. When you have a smart contract suite that anyone can inspect, it doesn't necessarily mean that it's going to be perfect. It doesn't mean that it's going to be bug-free and it will always work as expected. But the more people looking at it and the fact that it is an open system that anyone can permissionlessly inspect means that it can't do arbitrary things that you don't expect it to do, right? Short of bugs and things like that. So, once you agree on a set of rules, we say, okay, anyone can turn up to this platform, anyone can provide funds, and anyone else can turn up and pay an interest rate to borrow those funds without needing to ensure that, the parties are matched effectively, that, you maintain capital requirements, et cetera. The smart contracts enforce all of that. And I think that what that does is collapses the regulatory overhead that you need to ensure that the system is operating as expected. And that's really the regulatory arbitrage. It's the removal of the need for regulatory oversight rather than trying to get around, regulatory oversight or avoid it somehow.
So as I see it, we are building this new financial infrastructure, right? And you both mentioned that as well. But do you guys think this will translate to consumer apps, and how would that path look like to translate to what is being built now to actually consumer-facing apps and mass adoption? What do you think, Nick?
I'm probably. Hopefully, but I'm probably for me personally, I'm less focused on the consumer side of things. I'm more focused on the institutional side of things, and I guess there's a sliding scale between fully decentralized, smart contract, code is law, through to regulatory compliant. This is just another mechanism from a regulated entity. I'm sort of on the Kain's definitely more on the sort of the Ethereum production DeFi side, while I tend to be working more with traditional financial institutions and trying to bring them on that journey. So yeah, I'm less focused on retail, but you are seeing wholesale financial institutions creating more interest, and particularly around stable coins. So Sythentix obviously started off as a stable coin, but having existing financial institutions, whether it's commercial money, so banks issuing issuing a stable coin, or even central banks. We're seeing a lot of interest in that. There's been plenty of interest around the world. But even in Australia, for example, the Reserve Bank and their innovation lab last year did some experiments on Ethereum of what would an Australian dollar issued on Ethereum look like from a wholesale point of view. They're less interested, and they've made public comments about this. They're less interested in the retail side of things, but other countries aren't. So countries like Sweden, for example, are very interested in trying to create a digital version of their currency, and want to go down that path, but less so in Australia.
What do you think, Kain? How could that path to kind of mainstream adoption look like?
I think it's coming, but there's a number of aspects that are still missing. We talk a lot about scalability. That's something that I think to onboard hundreds of thousands or millions of consumers, you need scaling solutions, and those are in place. But I think there's actually something else. In my former life, onboarding people into crypto via local retailers with Blue Shift. One of the things that we identified pretty early on is that if you don't have the last mile connectivity to the existing legacy infrastructure, you're not really going to be able to onboard people. You'll get the enthusiasts and the kind of deep crypto people that are willing to kind of migrate to the crypto world, but that connectivity back into the legacy financial infrastructure is just required in order to kind of abstract away all the complexity that you have in crypto. That connectivity needs to be there, and it's only in the last few months that we've really started to see really strong inroads. So things like Bank Frick integrating USDC as a settlement method to get USD into the bank, and they're kind of a weird crypto bank, sure, but it's kind of the first step in my mind of breaking down that barrier to really integrating Ethereum as a settlement layer. And I think once that happens and you can get that last mile connectivity, then the consumer facing applications that can abstract away the complexity of the crypto parts, and use the legacy infrastructure where it's needed and use crypto where it's best suited, we'll be able to kind of create this holistic solution that will be far better than the existing infrastructure that we have now that we're used to. So I think that we're definitely getting much closer, and we've got a whole bunch of things that I think probably in the next 6 to 12 months are going to blow people away when you see these kind of end-to-end solutions that are fully integrated into the existing financial infrastructure.
Yeah, absolutely. And guys, remember to ask any questions in the Q&A for the panelists. Nick, do you agree that stablecoins is the perhaps the bridge to traditional financial institutions?
Yeah, certainly. Crypto, a lot of these assets are highly volatile, so having a stable store of value is definitely of value. Whether that's some sort of collateralized stable coin, DAI and Sythentix, or whether it's some sort of third party issuing it, like the Tether or someone else. But I think another thing in the space has been the development of the derivative space. Being able to short positions has definitely helped a lot, and obviously Kain with the Sythentix has done a lot in that space, but there are others as well, and there's new ones coming out. As a former runner of bots doing arbitrage between exchanges, being able to hedge out my trading stock. There was only a limited number of providers that could do that a few years ago. Now there's a lot more, and you can do it on chain as well, which is pretty exciting.
Fantastic. And so the institutions that you work with, Nick, are they more interested in distributed ledger technologies, or are they also exploring open blockchains like Ethereum and Bitcoin and so on?
Yeah, most are sort of they're at the intranet rather than the internet phase. So, they're trying these things. Some are trying to create the markets for themselves. We saw, well, probably 2 years ago now, I think, CBA did Project Bondi, where they issued a bond from the World Bank, but that was on their own sort of proprietary platform, and they talked about setting up bilateral blockchains between financial institutions. I don't think that's going to work, and I don't see other financial institutions are going to jump onto their platform. But it's pretty hard to set up. It's pretty hard to come up with a common protocol between financial institutions. Typically they need to be incentivized with some sort of shared ownership scheme, and even they're hard to do. You look in the payment space, look at the amount of effort it took to get the new payments platform NPP up, which is basically forced on by the RBA. So they're hard, and I often say we're a bit on the IT side of things here, but setting up a service-oriented architecture, we have different departments offering services within an organisation is hard, and it's very hard to get different departments to work together. Well, then in the blockchain space, you're trying to do that with your competitors, so it just amplifies it. But yeah, plenty of people are trying, and eventually someone will crack particular niche areas and become the standard protocol. There's certainly a lot of open source, open, I guess, public mainnet protocols to leverage and build on. And yeah, hopefully over time we'll see these financial institutions, adopting these and even partaking.
So Kain, I know you have some interesting thoughts about fintech and DeFi and how they compare. I thought that could be really interesting for our audience to hear about, because I think fintech is obviously the last few years has been a big trend. So what do you think we can do with DeFi that's not possible with kind of the larger fintech space?
Yeah, I mean, I think, when you look at fintech and all of the excitement around it, that probably arose in the sort of, early 2010s, right? There was a lot of promise. And I think one of the challenges is that when you're trying to build, overlays over this, legacy infrastructure, it's just really hard. Like even ignoring the regulatory stuff, right? You look at companies like TransferWise, where all of their effort is actually avoiding the legacy infrastructure, right? It's not leaning into it. It's trying to work out like how to, bridge the gap between local infrastructure, which is a little bit faster than, the kind of, international infrastructure like Swift networks, et cetera. That's just not a conducive environment for innovation. When you're fighting against, these headwinds constantly, from all sides. And I think that what Ethereum provides is kind of a blank slate, this open permissionless platform, as I mentioned at the beginning, where once someone deploys some new piece of infrastructure, it is by default accessible to everyone else. They can take it, they can inspect it, they can look at it, they can interact with it, they can incorporate it. And we're seeing more and more of that. So some of the Sythentix contracts, for example, have been taken and implemented into new projects by other projects even over the last 3 or 4 weeks, right? And that's just not something that you have the ability to do in the fintech world. And so I think that the promise of fintech over the last 10 years has kind of run up against all of these impediments and barriers to entry, and Ethereum really removes those. And so what we've seen over the last couple of years, which is a very small niche group of people, right? Like you talked about, MetaMask has been downloaded 4 million times. That's not much in the grand scheme. It's amazing from a crypto perspective, but from a real world perspective, it's tiny in terms of adoption, right? Probably 10,000 of those downloads are me, refreshing MetaMask every few weeks, trying to like cycle accounts and stuff, right? So, it's not like we've got, tens of millions of people, using this infrastructure. So we're still in the very, very early phases. But I think if someone has been excited about the potential for fintech innovation, and has been actively monitoring the space, they probably have a sense at the moment of frustration, that it's taken a lot longer. I mean, even the neobanks, right? I've been talking to neobanks for 4 or 5 years now here, and we really haven't seen much. There hasn't been too much that they've been able to achieve. We're getting closer, and I think they will do some cool stuff over the next maybe 12 to 18 months. But compared to what we've seen on Ethereum and in these open permissionless systems, it's just night and day. And so if you've been excited about fintech and you've been following it closely, and you have been a little bit frustrated, I think it's time to start taking a closer look at some of the DeFi protocols, because I think things that maybe you've been excited about are starting to emerge in this other space that is, as Nick said, there is some regulatory arbitrage going on here, but I think that's a good thing because it removes the impediments to innovation that we've seen in other spaces. So it's an exciting time, and it's worth jumping in and having a look.
Fantastic. So we're running at 12:30 here. We're running, I think we're going to wrap it up soon. Maybe last question for both of you. So I guess during this growth phase in digital assets, the last 10, 11 years, we have seen these different narratives coming and go, right? And right now, DeFi is the biggest narrative in crypto. And starting with you, Nick, do you think this is just another narrative in crypto, or do you think this is just the start of something much bigger?
Yeah, I'm definitely excited about the DeFi space. As we've sort of been saying, it's the building these financial Lego and clipping them together and creating these layers. And that, they are going to get more sophisticated, and it's going to be pretty amazing to see what is going to come out, because it's just constantly innovating. There's new stuff coming out all the time. It's pretty much it can be very hard to keep track of. But yeah, I think that interoperability, as we mentioned before, is I think one of the key benefits, rather than sort of an isolated chain or an isolated coin.
Yeah, that makes a lot of sense. And Kain, I think I know your answer, but let's hear it.
I mean, if you go back to the Bitcoin white paper, right, it is about replacing legacy, financial infrastructure, right, and it is very focused on payments. People forget about that now because we've got the digital gold narrative that's kind of emerged, store of value narrative. But Bitcoin was about creating an alternate payment layer that was censorship resistant. The challenge was that it just wasn't as programmable as we might have liked. And I think we've only in the last sort of 18 to 24 months gotten to a point where we've had everything in place to be able to actually start building this parallel infrastructure. And I think Ethereum has given it to us and made it possible. And the DeFi space has emerged, kind of out of that possibility. And so, really, it's always been about money. It's always been about payments. It's always been about this programmable money concept. I think we're just finally seeing it come to fruition, kind of a decade later. It often takes longer for things to emerge than you would hope, but we're finally getting there. So it's really time to start paying attention to it, I think.
Yeah, absolutely. There's so much activity happening right now, and especially in DeFi. So I think that's wraps it up for today in this webinar. And thank you so much to Nick and Kain for taking time for this panel. I know you both got very busy schedules. I think this has been a really great day. So thank you everyone for tuning in, and we hope to connect with you all soon again. And thank you for now, and we'll talk to you soon.
Thank you.
Thanks, Aaron. Appreciate it.